Good morning, ladies and gentlemen, and welcome to the 18th Asia Investor Conference. This is my 30th year at Credit Suisse, and I still think this is one of the most exciting, stimulating, and fun conferences anywhere in the world at any time of the year. So I hope you're going to enjoy it and find it very productive. To kick things off, I'd like to start by trying to answer what I consider to be the most important question facing investors today, which is, I put it in my terms, can reflation succeed? I'm going to define a little bit more closely what I mean by reflation in a minute, but my conclusions are that yes, I think it can succeed, but only if it succeeds in Europe and Japan, and only if we never stop being afraid of deflation, and we manage to avoid some of the most obvious and most serious geopolitical risks out there. More importantly, I think it can probably succeed this year in the sense of probably giving us the best spell of global growth that we have actually had for some time now. And it makes me pretty bullish about global equity markets for the year. Not necessarily for the next 5 minutes, but for the year. And for me, one of the biggest questions we have to sort of answer is, how are we collectively going to be feeling about the prospects for global growth a year from now? We are in an extraordinary situation right now, where long-term interest rates, and short-term interest rates for that matter, are back at their all-time lows, only seen twice before in the history of the modern capitalist economy. And in fact, in some cases, they're even lower than we've ever seen before. And this goes back to, for me at any rate, the early 1990s, when I began to think about the change in the structure of the world economy. And I came to the conclusion then that we were going to we were morphing into an era that would begin to look like the late 19th century, when you had deflationary growth in the world economy, an extraordinary increase in living standards combined with deflation, and in the end, long-term interest rates, long-term bond yields in the US and the UK, which were the leading countries in the world, which were in the 2.5% to 3% region. And I thought that's where we were headed back in the early 90s, to all-time lows for long-term interest rates and bond yields. I never expected the bond yield to be at 15 basis points for 10 years. So it's gone even further than I thought was imaginable at the time. And to be in that circumstance means that we also have a huge variety of different views about how this all ends. And I want to just consider for a moment 3 different views. I call them doom, boom, or divorce. And these are the kinds of, this is what I get when I talk to investors around the world. There are some who are convinced that we're headed for a period of secular stagnation, demographic decline, certainly in the West, the end of productivity growth, as we know it, and that when we finally learn that all this QE and so on, we just can't go on with it, the whole house of cards is going to collapse. That is to say, bond yields are going up and equity prices are going down, and at the same time, once it turns out that the emperors of the central banks have no clothes. And there are quite a lot of people who think that could be what happens this year when the Federal Reserve finally starts to raise interest rates. And there's a whole set of other quite gloomy long-term arguments that can go with that. So that's what I call the doom scenario. And there's some very sophisticated and clever investors who, in one form or another, subscribe to that view. And it kind of means there's nowhere for you to hide, or there won't be at some point. So that's one point of view about the world economy. Another point of view is that actually this year is the year that we begin to see how even Europe and Japan can start to escape from the deflationary clutches that they've been in. The reason that the world economy has not done very well after this enormous crisis and recession that we had in 2008 and 2009 is actually, as much as anything else, to do with the lack of income growth, and particularly with the tightness of fiscal policy around the world, and specifically and most importantly, the tightening of fiscal policy and indeed credit policy in Europe that came with the sovereign debt crisis. And if you think that that is actually one of the main reasons why we have so much missing GDP, it's kind of a more Keynesian view, then what's happening this year is really significant. Very, very, very significant indeed, because it means that on the one hand, we have an enormous subsidy, if you like, to real incomes and in most sectors, profits, from the huge drop in energy prices. Now, you can call that luck or not luck. Last year, probably my strongest single conviction was that we would have a supply-led collapse in oil prices a la 1985-86. And if you look at what happened to the world economy in 1985-86, with a considerable lag, with the benefit of some additional policy easing that accompanied the collapse in inflation expectations that came with that move in oil prices, we had a boom in the world economy. And we had a situation in which first long-term interest rates fell a couple of hundred basis points in a big hurry. Then they went sideways. Then they went up a couple of hundred basis points in a big hurry. And in the meantime, MSCI World went up 90% over 2 years. And the world economy really boomed. Now, if what we are seeing now is a perhaps slightly toned down rerun of that scenario with some important differences, then that's pretty bullish. And that's more what I would call the reflation thesis coming to life and actually showing up in real growth. And that, to me, is actually where I lean as far as this year is concerned. And then there's a third possible view. And that view is that the US is fine. They've figured out how to get out of this crisis. They're coming out of this crisis. But as far as Europe, as far as Japan is concerned, and now as far as China is concerned, there's no way. So we're actually heading for a divorce between the US and the rest of the world economy that's probably going to keep on getting worse and keep on driving the dollar ever higher. So for me, those are the three most common kinds of views that I find out there and that you can think about. And I want to make the case for the second one. So let me actually try and define a little bit more closely why I think reflation matters, what I mean by reflation, and why it's a useful concept for thinking about the world economy, and one that I don't think we pay enough attention to. So I'm going to actually ask you to read a few slides for once. The first point I would make is that history tells us, if it tells us anything, that the last time that long-term interest rates were this low and that deflationary risks, if you like, were this high, the 1890s and 1930s. Those periods were periods of outright depression. Both of those periods were called the Great Depression, in the United States anyway, in their time. And after depression, history tells us that we have had long periods of reflation. And by that I mean a period in which short and long-term interest rates are below nominal GDP growth And what that and for a long period of time. And what that means effectively is that the risk-free interest rates are below the rate of growth of cash flows for the economy as a whole. And that matters for the financing of the government, for the financing of corporations, and the access to credit and the cost of credit for individuals. It means that there is a persistent subsidy coming from the saver to the borrower. Some people call this financial repression. Whatever you call it, it's what happened for a long period of time after the 1890s depression and what happened for a long period after the 1930s. And after a long period of reflation, there was a return to more normal levels of output, employment, profits, and so on, but with quite a lot of turmoil in between, and not to mention the fact that we had a couple of world wars in the previous reflation episodes. So you can think of reflation, this persistent subsidy from savers to borrowers, as something that's happened before. It's historically not unprecedented. You can ask whether or not it's possible to do it in today's world economy, and you can observe that there are some other aspects of it which are very fundamental. If you're more of a micro than a macro person, today's incentive structure is very, very much for firms to borrow to buy back their stocks. This is something we've seen obviously in the US. We start to see potentially happening in Japan and indeed in Europe. And it's something which is going to be there so long as we continue to have this particular structure of rates and so long as cash flows are growing faster or at a faster rate than the level of interest rates. Now, of course, there are other forms of deleveraging which are possible, and other forms of deleveraging which some people think are more desirable, most notably outright debt default. Why don't we just get rid of this stuff and move on? And and again, history tells us something about that. It tells us that some countries have resorted to outright debt default in depressions. Greece is a notable example. They defaulted in the 1890s, they defaulted in the 1930s, and they've defaulted this time round as well on their private creditors. And now they're figuring out whether they're going to default on their official creditors. But not all countries default. Another possible answer is hyperinflation. That was a fashionable scenario a few years ago with all this money printing. Well, where is it? It's not visible on the horizon just right now for most of the developed world. It usually happens in sort of context of complete political failure or war and economic collapse. And so far we haven't had any of that. And then there's the possibility of devaluation or protectionism. And what we are seeing is, in Europe at any rate, a policy, and Japan, a policy that has a large dose of devaluation, competitive devaluation in it. And that's something that could become disruptive if it goes too far and too fast. So from my point of view, these alternative to this long, persistent reflationary process, financial repression, subsidy from savers to borrowers, the alternatives mostly are more disruptive, potentially more politically destabilizing, and in a sense undesirable, at least in part. So I think reflation is part of the cure that we've had historically, and I think we begin to see that it's part of the solution to our current set of problems. And although there have been depressions, many of them in individual countries, as I mentioned before, it's really only in the 1890s and the 1930s that we've had depression at a global level. And on both of those occasions, we had above average private and sovereign debt default. We did have competitive devaluation. We did have protectionism, and in some cases hyperinflation. So different countries pursued different strategies in the face of depression. But in the longer term, reflation became part of the solution just about everywhere, and I'm going to illustrate that for you a little bit later. And it is indeed what we need now, even though we haven't had depression literally in the developed world. We've managed to stave it off so far. Only Greece has had a true depression, the kind of decline in output and increase in unemployment that you saw in the US in the 1930s, and they are the exception, not the rule. But even though we haven't literally seen depression, we've had all the classic political symptoms and many of the economic symptoms of depression. We're still shy by a large amount of previous trends in GDP, whether it measured in nominal terms or in real terms. We still have massive underemployment or unemployment in very, very large parts of the world economy. And as mentioned before, long-dated bond yields are back to the levels we've never seen before, except in the aftermath of depressions. I told you already that I think this can succeed, but there are some caveats. In particular, you have to be truly afraid of deflation. And you have to stay truly afraid of deflation for a long period of time in order for this to succeed. If you start worrying too soon that, oh my God, if you have interest rates artificially low in this way and below the rate of growth of nominal GDP, and that the gap must be closed in a hurry because otherwise you're going to get a bubble here and a bubble there and this, that, and the other, then you're going to lose this battle. And losing this battle is trillions and trillions and trillions of dollars of actual and potential GDP. And you have to accept that you need fiscal policy to back up what the central bankers are doing, and you need the ordinary saver to subsidize, ultimately, the entrepreneur. And that's where perhaps the biggest questions might be about Europe, applying this policy to Europe and Japan. But let me point out, since this is Asia, that the Asian development model has for years been based on the idea that savers subsidize ultimately the entrepreneur and the development of the economy. This is the region where interest rates are typically, constitutionally, all the time below the rate of growth of nominal GDP. The saver gets a raw deal. But in return for that, capital is made available at a low cost for investments in infrastructure, often by the government, and for investments by the private sector, and for entrepreneurial activity and growth. That, for me, is been a phenomenally successful model. Now, I admit some of the time it comes with capital controls. A lot of the time it comes with special measures designed to kind of counteract the tendency of cheap money to inflate property prices or other asset prices and to create instability by the back door, so to speak. And we probably need to think about those issues just as much in this situation. Nonetheless, the idea that the saver subsidizes the borrower, the saver subsidizes the entrepreneur, is actually what reflation is all about. And I wouldn't actually be that bullish about the outlook for the world if I didn't think that there were massive investment opportunities out there to be financed by this low cost of capital and borrowing. And maybe at the very end, I'll have a time to tell you about what I think where those opportunities lie, particularly in the transformation of our energy system, in the development and absorption of what I call the second machine age, or the fusion of man and machine on a scale that we've never before seen in history, which makes some of my more thoughtful friends wonder whether Marx was right after all, and the machines are going to do all the work and create all the such a big surplus that the only thing that we need to worry about is the distribution of that surplus and who actually gets to own it and spend the fruits of it. And for that matter, the completion, if that's the right word, of the European project. Europe, for my money, is still a very, very, very incomplete structure, one which is politically teetering on the brink of a phase in which it begins to disintegrate rather than to grow and get stronger. And one of the big questions is whether this coming year or two is going to take us into a period of disintegration in the European system, or whether or not we're going to get enough growth and enough political courage to actually turn that to the advantage of making Europe stronger in the future. So anyway, that is what I see as being the central, really big central questions for the world economy. In this sort of survey, it would be wrong for me not to say something about the elephant in the room, which is China, which is right on this doorstep. I'm always a bit hesitant to give any opinions about China. I'm a Westerner, what do I know? There are so many people in this room who have so much more detailed knowledge of what's happening in China. But there too, I think there's an epic story potentially being played out. The development model that has served China reasonably well and led to a phenomenal growth in prosperity and output over the last 2 decades has reached the limit of its effectiveness. And the kind version of what the current leadership is trying to do is to try to refresh that model, change it and morph it so that it becomes capable of delivering a higher quality of growth, a more sustainable growth model. If that succeeds, that will be very, very bullish, not only for China, but ultimately, I think, for the world. If it doesn't succeed, it'll be very risky. As far as the short-term outlook is concerned, my guess, it's very, very difficult to tell sometimes these days as the Chinese data seems to get worse and worse and worse, but my guess is that things have been through a pretty rough patch in terms of growth, and they will get marginally better rather than a lot worse over the next 6 months or 3 to 6 months as a result of the policy measures that are being taken right now. And what that means is that while I can keep an open mind about how successful the reform process is actually ultimately going to be in China, then as far as the outlook for the next phase, so to speak, is concerned, my guess is that China's not going to bring the whole thing crashing down in a heap because some terrible accident happens over there, and that's important for the outlook that I'm going to describe. So let's just talk a little bit in the context of this, what I call secular story, where we have 4 possible regimes, which I call disinflation, which is what you tend to get when you are afraid of inflation. You're having deregulation, and the underlying debt situation is rather low. That is to say, people are not burdened by debt, so demand growth is relatively easy to come by, and so on. If you are afraid of inflation and you're deregulating in those circumstances, you end up with a disinflationary boom of the type that we had post-Reagan and Thatcher and so on. If on the other hand you have an acute fear of inflation and you have a very high debt stock regime, then the chances are you're going to find it very, very difficult to get enough demand growth. And while people remain obsessed, and policymakers remain obsessed with inflation, the danger is that you're going into depression. And in a sense, we have been oscillating over the last 5 years between the sort of should we really be afraid of inflation? And every time there's a bit of growth and a bit of recovery, we start going into tightening fiscal policy and the thought of the need to tighten monetary policy and getting very worried about inflation, and we sort of push ourselves back into the risk of depression. So that's what's been happening up until now. If, on the other hand, you're truly afraid of deflation, and usually in those circumstances there's a certain amount of re-regulation going on, and you've got a low debt situation, you're probably going to get excess demand growth and ultimately a lot of inflation. And that's what we had in the 70s in the West. It's what a number of Asian countries had in the really rapid phases of their development post-war. If you're truly afraid of deflation and you're in a high debt regime, you get reflation, which is where I think we need to be. So if that's the secular context, what's the outlook, as it were, in brief, from here on a more cyclical basis? And as I've mentioned already, I think that the most important single factor that changes the outlook for the global economy and makes it more optimistic than it has been for some years, as far as the West is concerned particularly, but also for large parts of Asia, is the energy booster that we're getting from the sharp fall in energy prices last year. And I've already mentioned the parallel with 1985-86, but let's just stick for the time being to have a quick look at how we're doing in this, which is my most sort of sensitive indicator of global growth, and how that stacks up against investor risk appetite. And here's a couple of remarkable points. First of all, we had a lot of volatility in global growth during 2014. When I stood up here last year, we were about there, and I was warning that we were in for a little bit of a slowdown. And I was thinking that that slowdown would come to about here in the middle of the year and start to re-accelerate. And what actually happened was that a almost random event, MH17 being shot down by the Russian separatists, galvanized a complete funk, basically, in the European economy. And we went from a situation where Europe seemed to be starting to recover and come out of its sort of sovereign debt trap to a situation where growth just disappeared, particularly because of the sharp negative effect that event had and the imposition of sanctions had on German business confidence, growth, and so on and so forth. And ultimately, that's helped to give us QE. But what happened was that we ended up with a very sharp slowdown. A few special effects maybe made that look worse than it is. We've had a slightly bigger than you might expect rebound. And then we're just now in this phase, which is a slowdown, which, as much as anything else, reflects the weakness in China and what's happening in the US economy, which paradoxically, this year is tracking very, very weak. In fact, if you look at the Kansas City Fed nowcast of GDP, it's currently at 0.5% per annum for Q1. Virtually no growth. Now, a lot of that is weather, some of that is the port dispute, but some of it is also the effect of the oil collapse on investment and activity and employment in the oil sector. And I think the bad news hasn't quite finished yet in this sense that counteracting that for the last few months, we've had enormously strong growth in employment. I think that's actually probably statistically a little bit overcooked, and I wouldn't be at all surprised if we get much weaker growth in payrolls over the next couple of months. And whenever and whatever the Fed decides in terms of beginning to tighten their interest rates, what will matter for the impact on the bond markets is just how strong, not just the US economy, but in my opinion, the global economy is at the time. So I think we've got a kind of reprieve, and in a sense, after Ms. Yellen's intervention last week. I think the bond market's already got hold of this. We've got a reprieve because we've got a little bit of a slowdown coming in the short run. And then as we move into the second half of the year, particularly from the April-May period onwards, I think if you look at the underlying income growth and you look at most of the indicators, they're consistent with a re-acceleration and a period of strong growth that could last well into 2016 for global industrial production growth. So that's the sort of state we're in. If we look at the state of investor animal spirits, so to speak, as measured by risk appetite, then you can see that investor risk appetite looks as though it's been rather depressed recently. And you can ask, well, how can that be when stock markets are close to all-time highs and so on? Well, that's partly because when we look at investor risk appetite, we also look at, we're looking mostly at the relationship between the risk-adjusted returns on safe assets like bonds versus risky assets like equities. And bonds have done phenomenally well, and we have bond yields right down here. So if you didn't know about equity markets, you looked at bond yields, you'd say, oh my God, what's happening? The world's about to end. And then you look at equity markets, they're up here. So the low state kind of number for investor risk appetite reflects the combination of those two things. But there's something even more interesting about this. Although this doesn't go all the way back to 2008, 2009, when we were in deep panic, we have now gone the longest period since 1981 without having a risk appetite euphoria as we measure it. It's 6 years, more or less, to the day since the equity markets bottomed in 2009, and we haven't had a euphoria. That hasn't happened since 1981. There's never been such a long stretch without a euphoria. In the run-up to 2007, there was nearly as long without a panic. That turned out not to be a good thing. It kind of told you that we're all wildly over-optimistic. And the state of risk appetite is rather well correlated with the state of financial leverage or in the world economy. When risk appetite is strong, people tend to leverage up a lot. So when policymakers say to me, yes, but look, aren't you just inviting another set of bubbles? I say, well, you know, if only we'd got there, if only I could see the symptoms of irrational exuberance and excessive risk-taking out there in the world economy. But this is one of the things that tells me it ain't happening yet. So the situation we're in, I think, is that we're in a slightly we're about to pause a little in terms of the recovery. And then as the year wears on, I think we're going to see the real benefits of lower oil prices. And despite equity markets being at or near all-time highs in many, many different places, the state of investor risk appetite is anything but wildly optimistic. And if you would take the 5-year moving average of risk appetite, it would still be way, 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 way below average. So then let's have a look at something very, very simple. I love this chart. I love charts which say a lot in 2 lines. This is what's happened to US corporate profits since 2009. Now, a lot of people tell me that the reason this whole house of cards is about to collapse is because it's all totally artificial. Without this QE, there wouldn't be any. Look at the economy; it's terrible. Well, look at profits; they're not terrible. In fact, they've gone up a ton. They are way above trend, in fact, whereas the economy is not. And then you contrast Europe. Was recovering in line with the US more or less, and then we had the sovereign debt crisis. And this little sign here is incredibly important. We have had no profits growth in Europe for 2 years. I think that is just beginning to turn. And I think that the ECB, as so often happens with central banks, is just about to, well, I won't say throwing fuel on the fire, but is about to ease into a moment where profits are beginning and were beginning to turn already. But there's also, of course, another story, that what's happening to US corporate profits is that they are clearly leveling out. And they're leveling out for 2 reasons. One is oil, and the other is the dollar. If you took both of those things out of the equation, corporate profits would be growing at 5% or so, more or less in line with nominal GDP. So what's happening today is not only that we are getting a generalized subsidy to income growth and non-oil profits from cheaper energy, but we're getting a massive redistribution of profits towards Europe and Japan from those exchange rate moves, a relative price adjustment, which is really showing up now in the data. And finally, I would say that this contrast between these 2 things is pretty extreme, and obviously it's partly why the dollar is where it is. But we are apparently about to go into a phase where this gap may actually close a bit. The upside potential for European corporate profits is much greater in principle than it is for the United States. And the final thing I take from this simple chart is that this is really a large, large part of the missing demand in the global recovery so far. And that is not down to secular stagnation. It's not down to demographic decline. It's not down to the death of productivity. It's down to fiscal policy and the impact of the crisis on credit in the periphery in Europe. And this is a huge, huge part of global demand. And it went missing for 2 years. And we've reached the limits, I think, of what Europe can withstand politically in terms of fiscal tightening. And just as important in this general story for the next couple of years, in my view, is that Europe is beginning to move away from austerity, and at the very least, fiscal policy is tightening by less, much, much less than it has done over the last couple of years in 2015. And some elements of fiscal policy are potentially becoming more stimulative, particularly the focus on public sector investment. These are themes that are not going to change very quickly, and provided that we don't have another really serious political accident, are going to contribute quite strongly to the recovery in European corporate profits, both in absolute and in relative terms. If we look at where the dollar is right now, here's a little chart which shows the black line here shows the inflation-adjusted two-year forward differential. It's not a bad summary indicator of the impact that interest rate differentials tend to have on the exchange rate, which is the blue line. And what you can see is that things move in roughly the same kind of direction, but occasionally the exchange rate overshoots what's happening with interest rate differentials. Occasionally it doesn't really pick up properly on what's happening to interest rate differentials. If anything, we're overshooting now. In the last few days, I think we've begun what I personally believe, in the context of the data that we'll see for the next few months, is probably a reasonably decent-sized correction to the one-way traffic of the dollar strengthening against the euro weakening. Having said which, I'm still biased towards the idea that over the fullness of time the dollar will end up stronger, but we may be trading at 115 or 120 before we go into another phase of the euro trending higher again. And that in itself has some short-term implications for the distribution of performance within the equity markets. Europe so far has been led higher by exporters, and mostly by exporters and not by domestic sectors. And that's, I think, maybe changing a bit in this coming quarter. If we go back to the energy story, Another thing that I think is very important in the outlook going forward is what does happen to energy prices. Where do they go and where do they settle? There's a huge amount of debate. There are a couple of great panels on that in this conference and so on. So I'm going to give you my very simplistic version of this, which is so far we are tracking almost to the cent a profile that we've seen before back in 1985 and 86, the last time we had a supply-driven drop in oil. And this is Brent rather than WTI. But you can see from the very peak, and this is the blue line is what happened from 1979 onwards. This is the peak in oil prices with the first Iranian, with the second oil crisis and the Iranian Revolution and so on. This is October 1979. You see how it gradually trickled down and then collapsed at the point when supply really started to overwhelm demand. And you can see that aside from the Great Depression, the Great Recession, I should say, Freudian slip that, you had this kind of parallel movement in oil prices during the last several years. And then, in fact, I showed this chart at this time last year, and it was one of the things that made me think that we could have this collapse. And look how closely it's tracking at the moment. And interestingly enough, it suggests that, you know, we haven't yet necessarily set the low. It may not be that far away. And then at some stage, if global growth really does get going, and the sort of huge amount of oil that we have in storage and so on starts to be absorbed a little and so forth, and people start to feel more confident about holding oil in storage, then we can see the oil price perhaps bounce back towards some kind of medium-term equilibrium, which I would put in Brent terms at somewhere between 60 and 70 bucks or something of that sort. But you need the global recovery as part of that story, as well as progress towards reduced supply as a result of the collapse in prices that we've already seen. So that's kind of what I think is the most likely shape, if you like, of oil prices. It may take a bit longer this time round to get things going. A lot depends on what the Saudis themselves do. A lot depends on what happens with the Iranian deal. So I'm not saying this is the best, you know, that's all factored into here. But that's the kind of architecture of the profile for energy prices from here that I would expect. And then there's one other parallel with 85, 86, which I think is instructive, which is what happened to long-term interest rates. Here, 10-year Treasury yields, subsequent to the collapse in oil prices. The blue line again, this is where oil prices collapse. You get a huge rally in Treasuries. They come down very, very sharply, and we've followed that script. We've even followed that little bounce. Then they go sideways, and then in 1987, they start going up very, very strongly. 1987 and towards the end of 86 and going into 87 is when the global economy really started to motor as a result of the stimulus from energy. It took a long time for the positive effects to really accumulate and really get the world economy growing strongly. And that's also when the Fed started to tighten, and you had a very large sell-off in long-term bond yields. Somewhere from towards the end of this year, third quarter onwards maybe, we'll get to the point where the global economy really is motoring, when we're at the other side of the inflation fall, headline inflation starting to rise. And by that stage, wages really should be starting to pick up a little bit more noticeably in the US. And the Fed will eventually decide to tighten. And to me, that is a period of much greater risk for long-term interest rates than, say, the second quarter, where, as you saw earlier, I'm expecting a bit of a deceleration in global growth. I borrowed this chart from our technical analysts, who are very good. Anybody who knows anything about technical analysis will tell you that's a fairly bullish chart. Actually, it's a couple of weeks out of date. Now, there's some danger that we've overcooked it a little bit in the short run, but really that's a very, very positive chart. It suggests that we've been through a long period in which global growth has slowed, in which the equity markets have sort of digested a lot of the gains that they made in 2013 and all the way back to the middle of 2012. And now they're ready for another big leg upwards, but this time led by Europe and Japan, not by the US. Did I mention that MSCI World went up 90% in the 2 years from October 85 to October 87, and that we ended up in euphoria, and then we had the stock market crash? Well, I don't think MSCI World's going up 90%. But in terms of the economic outlook, thinking about the sort of reflation story that I was talking about earlier, plus this cyclical boost from energy prices and the easing of policy in Europe, my guess is that this is going to be a pretty strong platform for another major advance in global equity markets. Let's have a look at this reflation thesis a little bit more, because I want to emphasize how important this is in my thinking about the world. And then at the very end, I'll say a little bit about some of the structural themes, what we can do with this cheap capital. First of all, if you look at 10-year yields, which are the light blue line, and I apologize for people on that side of the room, and in that side of the room it's quite difficult to see the central screen. But the blue line is 10-year Treasury yields. The faint grey line here is the year-on-year growth of nominal GDP, which is a fairly volatile beast. So to give you some feeling for the underlying trend of nominal GDP growth, I've smoothed it over 2 risk appetite cycles. One full risk appetite cycle and global industrial production cycle is roughly 40 months. So this is an 80-month smooth, and that's the black line here. And you could think of that as being, you know, we carry around in our heads some sort of idea of what the underlying trend is, and maybe that's quite a good one, 2 cycles worth of growth, and so on. And so the critical thing for me about reflation is literally, if you look at it month by month, quarter by quarter, it's the gap between this grey line and the blue line. Is the grey line above the blue line, in which case you're in this condition where nominal GDP is growing at a faster rate than long-term interest rates, and you're getting a subsidy, if you like, to the borrower, or vice versa. Well, you can see that the story of the 1970s and 1960s was that we had accelerating nominal growth throughout that period. And throughout that period, long-term interest rates and short-term interest rates were below nominal GDP growth, sometimes by a very large amount. And then, after Volcker, it went the other way, and we had bond yields above nominal GDP growth. And then after the tech bubble in 2000, we had Greenspan, and ever since then, Treasury yields have stayed below actual nominal GDP growth, except in the Great Recession, and below the trend, the underlying trend of nominal GDP growth. That is reflation. And what you can see is that nominal GDP growth is pretty robust now. And if anything, this 2-cycle average is going to be moving up here. So there are a couple of different issues for me. It seems to me that we're going to have, we'll probably end up with yields higher, partly because, but not necessarily closing that gap. And if that gap closes too fast, then the whole reflationary stimulus will be taken out of the system, and we'll be in a very risky place for global equities. And so this is kind of a chart that you can use to think about the potential consequences of Fed tightening and so on. And it worries me a bit that there are still some members of the FOMC. I'll be introducing an ex-member of the FOMC on Wednesday morning who are still more worried about inflation than deflation, and who are very worried by the fact that short-term interest rates are so far below nominal GDP. If they literally wanted to close that gap in a hurry, I would take cover if I were you. But now let's have a look at that same graph for Japan. And you'll notice that in the early part of the collapse of the bubble, that actually long-term interest rates were above actual nominal GDP growth, but sort of below the underlying trend. But then we had an attempt to sort of close that gap again, and it failed, and then you had a long period, all the way from 96 onwards, basically, in which, despite nominal yields being so low, Japan was stuck with a situation where nominal yields were above nominal GDP growth for 15 years. And what's just happening now, this is another way of thinking about whether Abe and reflation and the BOJ's policy is finally starting to get some traction. This doesn't mean to say that if they do something silly with fiscal policy that's not going to impact the Japanese economy. But from the contrast that you see between the Greenspan policy and the policy that was actually followed in Japan, you can begin to get a feeling for the difference in the outcomes that you got in the economies. That's how important it is. So now let's have a look at the euro area as a whole. This is a weighted average of Germany, France, UK, Germany, France, Italy, and Spain. And you can see that this is just starting to come down. Long-term yields as a result of QE are just starting to decisively cross over a rising trend for nominal GDP. Reflation has finally arrived in Europe. Now, if you put that together with the fiscal outlook, which is less contractionary at the very least and possibly more expansionary, that is actually the best policy setting we've had for European growth in a very long while. If you decompose that into different countries, you'll see that Germany is doing fantastically well in the reflation stakes. It's being subsidized by, borrowing in Germany is being subsidized enormously by the fear in the periphery. France is sort of somewhere in between. We've had sort of yields and nominal GDP tracking very closely and now finally below. And then Italy just about crossing over. Not crossing over trend, but and Spain, the same thing. This is enormously important. Reflation is really starting to work. So since we're running short of time, I think the way I'm going to end it is this. Reflation for me is about when equity is about the subsidy from savers to borrowers. It's enormously important. It's also about equities outperforming bonds. And if you look at the two big periods of reflation that I referred to earlier that came after the Depression of the 1890s and the 1930s, you'll see that this is US bonds outperforming, this is the ratio of returns on US equities to US bonds. And you can see just how much and for just how long equities outperform bonds in those periods. And you can see that we're just about breaking the long-term downtrend in equities versus bond returns. We did that in 2013. But we did not do it on the global level. If you look at the same sort of chart for the G5, that is to say the US with Japan, Germany, France, and the UK, we hadn't broken that downtrend for equities, in equities against bonds until just now. So the moment that we actually meet in this room is the first time that you can see a whole lot of factors coming together which suggests that at the global level, or at least the developed world level, reflation really is starting to work. And that, I think, is the significance of the moment that we are at now. And in terms of how much headroom we might have for equities to go higher, it's not a huge amount for the US if you look at this chart in one sense, because we already have long-term returns above the rate of growth above their trend. If, on the other hand, you look at some of the periods down here in the 1960s and the early 1900s, periods after reflation, you'll see that we were 1 to 1 and a bit standard deviations above trend. If we were to get there over the next, say, 5 years, then you would still have above average returns on equities. If you were back at the trend in 5 years' time, you'd have something like 4% per annum nominal returns in equities. Slightly better than bonds, but not a huge amount to write home about. But my thesis is that we're not going there unless the rest of the world actually manages to be successful in restoring growth, profits, and so forth. And that's really the agenda for this year. And if you look at valuations on the same simple basis, then Japan and Europe are a little bit behind the US, should have more upside potential. So that's really where I think we are. I think we have some cyclical luck, that's energy prices. I think we have policy, which is now finally outside the US, moving into a decisively stimulative direction. And as long as the Federal Reserve holds its fire a little bit, that's basically an extremely positive economic backdrop for this year. Now, I've deliberately not said anything about all the political risks in detail. You're going to have plenty of opportunity to consider those over the rest of the conference. So with that, I'm going to sign off and say thank you very much for listening. Have a fantastic conference, and I hope to see you again next year. Thank you very much.